Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com, or whatever your favourite podcast platform is. This is episode number 37 in our series for 2025, and today's date is Friday, October the 24th. First, I'll be talking to Neil Druce, the founder of Junee Licorice and Chocolate Factory. We'll be talking about how his business was the first to make organic licorice in the Southern Hemisphere, why his firm's organic chocolate is healthier than other chocolates around, and the importance of agro-tourism for his business. And I'll be talking to AMP Capital Chief Economist Shane Oliver about whether we can expect a Melbourne Cup rate cut, about the impact of Trump's tariffs on the global economy, and the economic impact of the US shutdown. But first, let's talk to Neil Druce.
Well, Neil, tell us about the Junee Licorice and Chocolate Factory.
Okay. We started 1998 to value add to what was produced on the farm. My father turned organic in 1962, and the first thing we made was flour, organic flour, but that really wasn't just by the time you transported it wasn't a thing that was going to take off. So we went the next step to value add to the flour, and we made organic licorice, which was the first organic licorice in the Southern Hemisphere. So hooked into that. The marketing was quite easy because we had no competition. And then in 2003, we put chocolate around that licorice. So we did organic chocolate on organic licorice. So that's about it.
So it's organic chocolate?
Yes, it is. And look, the very interesting thing with chocolate is it's the most sprayed food we eat. The only thing that compares is tobacco. We don't really eat that. So therefore, it makes a lot of sense to have organic chocolate, because it grows in a rainforest condition. So therefore, it typically needs a lot of spraying.
Right. So they have a whole lot of pesticides and stuff like that.
They do. And look, the part of it is the trees. Yes. Part of the agriculture is the trees. They grow conventionally too close together, and it harbours the pests. So if you grow them a little bit further apart, it's a lot better system, and it's self-regulating for health.
I suppose other chocolate would contain things like artificial flavours and colours, other unappetizing non-food ingredients. Would that be right?
Look, the main thing is the residue from the chemicals that are put on and the pesticides and weedicides. So you got three levels of chocolate though when you're talking about artificial flavors and colors. The bottom is the chocolate that would typically be a muesli bar or something like that, and that is artificial color, artificial flavor, like just with hydrogenated oils. Then you've got compound chocolate, which there's a lot of that in Australia. And that's where you do have the cocoa mass, but you don't have the cocoa butter. And again, you use hydrogenated oils, which is very bad for your health. And then at the top of the tree, you have the curvature chocolate or European style that uses the cocoa butter and the cocoa mass. It's hard to work with because it has to be tempered and things like that. But they're the three levels. So at the top of the tree, you've got obviously a better product and better for your health.
So you run a business in regional Australia. I mean, what's that like?
It's good. There's a certain amount of disadvantages, like we're so dependent on the internet. So we've got things like that where our services are poor, but we have some incredible advantages. I find that the price of land and buildings is cheaper. The supply of quality employees is there, but it's not too many. And it's I don't know. You have to run a business in the country. You have to have a bit of integrity because there aren't as many people around, and they remember if you rip them off. So you've got to do things like that. But I love it. I think it's quite wholesome. I'd love to see Australia a bit more spread across the country and use our beautiful land instead of consolidating on the coast.
And you run the business with your daughter, Rihanna?
Yes, we do.
What's that like?
It's good. We spend nearly 7 days a week together, and look, doesn't always work for people. I've heard stories, but we certainly get along. She's very honest and tells me when I'm being dumb and things like that. So that works all right. As long as you're big enough to accept it. Yeah. We don't always agree, but that's when it's wholesome.
So what happens when you disagree with her?
We have a discussion, Leon. and we work through it. And I think we're both big enough to think it through. And even if it's the next day, we come back and we go, all right, this is where I think it's at. But she'll tell me things like, and this is great for an old 60-year-old like me. She'll tell me things like, so Dad, actually in business she calls me Neil. And she's been joining since she was about 14. Neil, just because you were trendy and cool in the 2010 doesn't mean you are now. And I think every 5 years you've got to reinvent yourself. So that's been a good lesson for me, because you think, I've got a great place here. People will want our product and want to come and visit, but in all reality, they won't keep wanting to do that unless you keep visibly improving.
Well, tell us about your market. What is your market?
Okay. We got two different markets. We've got our wholesale market, and that's where we sell to upmarket delicatessens and organic fruit and veggie stores and suppliers of organic, and therefore our customers there are people. And we did a bit of a survey on them. I thought they were buying our product because they weren't getting the chemical residue. The number one reason for buying the product, other than liking to eat it, is that they want to save the planet. It's a very, very big push that nobody wants to be buying a product that is destroying the planet. So they're the people that are concerned about the future, but also they're bits of foodies that love good quality chocolate with good almonds and macadamias and licorice and different things like that. So that's one market. The other one are the people that visit here, and to be honest, they want to come to a venue with ambience, great customer service, and good food and drink. And they don't, to be honest, I think that only 5% or less care that it's organic. So that's a totally different market. Yeah. So
chocolate eaters are a certain kind of people.
Well, 97% of the Western world crave chocolate. So yeah, she's pretty broad brush.
And licorice.
Licorice.
That's quite a distinctive market.
It is, and particularly the black licorice. So people my age are very used to the black licorice, but people my daughter's age, they've had the green apple licorice, and they've had red licorice and different things. So they're looking for all sorts of things. I think around about 40% of people like licorice. So it's not everyone. It's the aniseed flavour and the licorice flavour. The ones that like it really get into it and eat quite a bit. And it is good for you. The licorice powder is actually one of the biggest builder of the immune system known to mankind. And incidentally, in 2013, when SARS disease came out, it was licorice root powder, the only thing that fought against SARS, which COVID is a type of SARS as well. Yeah, so the licorice eaters, they're a smaller group, but they're quite passionate, and they're looking for good licorice. They're looking for the old-fashioned licorice that they had when they were in school, and that's what we do.
Okay, so where do you see the company developing from here?
What we're looking at is to get more and more sales on site, more and more people visiting and connect up. We have another company that in Corowa, we make whiskey down there, and we also do the licorice and chocolate, selling it down there, and to be involved in more food production areas. Like value adding to agricultural produce or agritourism. That's where we want to go and develop that. Also selling to the wholesale side, a bit of an emphasis on meeting the public and selling to them and giving people a good time, which in a way, when times are great, we want to be able to look after people, but also then when times are tough and the economics are down a little bit, we want to be able to provide a little escape at our venues for people to go and to enjoy a cheap weekend or a cheap afternoon.
And agritourism would be quite an area to get into.
Yeah, so when we've done the studies on the Riverina, that's sort of the strengths of the Riverina. Some of the greatest production of agriculture is happening in this area. It's really interesting. The 5 richest wine families families are here. 5 richest wine families in Australia. The majority of your citrus for Australia and different things like that. So I think it's the food bowl of Australia. It's the highest protein producing area in Australia, and I think agritourism fits in. People are becoming more and more interested in where does their food come from, how does it work. It's not just something you grab off a supermarket shelf anymore.
Well, Neil, thank you very much for your time. Wishing Junee Licorice Chocolate Factory all the best for the future.
All right, well, thank you very much.
And now let's talk to AMP Capital Chief Economist Shane Oliver.
Well, Shane, judging from the RBA's statements following the last session, we shouldn't be too optimistic about a rate cut in November. Would that be right?
That's right, Leon. I think it's become a very close call. I think there's still some chance, a good chance they might cut, but it all depends on the inflation numbers that come out at the end of this month. Bottom line is that the inflation numbers for July and August are on the high side. We all know the monthly figures are a bit volatile and you can't totally rely on them, but the indications are that it may mean upside risks for the RBA's September quarter inflation numbers as a whole. And so they're now the key factor in all of this. And that, of course, has all led to the Reserve Bank being somewhat more cautious in their recent commentary, and I guess markets concluding that we may be closer to the bottom on interest rates than many of us, including ourselves, thought might be the case. I mean, we think there's still a chance that you could get a cut in November, but I'd have to say it's a close call. It does depend on those inflation numbers coming in around maybe 2.6% for the trim mean or the underlying rate, or at worst 2.7%. But there's a lot of economists out there who say it can't even come in higher than that. And of course, that would then see the Reserve wait probably till next year. So it's a fairly close call now. I think bottom line is, though, that the Reserve probably will cut again at some point in the next 6 months. And that's simply because the economic recovery, I think, will remain fairly subdued and inflation will go back to target, but the timing of that is now pretty uncertain.
A lot of the traders are expecting a rate cut in February.
That's right. The money market numbers have moved around a lot. The expectation for November is now about a 46% chance, and the expectation for December is a 70% chance. Now, mind you, those numbers are substantially higher than was the case on Friday, and that's after the latest spat between China and the US on tariffs and trade. So we have seen the money market sort of jump up a little bit, but all told, the money markets are only saying, I mean, we don't get a rate cut fully priced in, according to the money markets, until February. It's not fully priced in until February. It's a 100% chance, and the money markets are now saying maybe a cut in February, some chance later this year, and then a 39% chance of another cut sometime through the course of next year. In other words, the money market's pricing in one or two more cuts, but those numbers are bouncing around all over the place, depending on the latest piece of news. And of course, they've recently got a boost, not from the Reserve Bank, but from the uncertainty about global trade again after Donald Trump's latest tariff threats.
More of that later, but the latest jobs figures aren't that encouraging, showing very low jobs growth. And it wouldn't be surprising if the unemployment rate rose to about 4.5, 4.6% in the next 3 to 6 months, which would perhaps suggest that the RBA might cut rates in view of that.
That's right. It's a sort of a somewhat uncertain picture. The jobs figures, well, on the one hand, unemployment 4.2%, still historically low, so that's an argument to hold off on rate cuts. Flip side is that jobs growth in the last 3 months, I think, was averaging about 8,000 jobs a month, whereas in the prior 3 months was averaging close to 40,000 new jobs a month. And when you look at things like the ANZ Indeed survey of job ads, Seek Job Ad survey, and so on, they're all suggesting that it's continuing to soften. And so there is a bit of uncertainty about the jobs numbers. So I think you've got uncertainty about inflation, and there the most recent July, August numbers, the uncertainty is sort of more on the upside. Flip side, though, is you've got these jobs numbers which look to be a little bit softer, notwithstanding the still low unemployment rate. So that's why I think it's hard to rule out there being another cut or two, because I think the economic data we're getting is consistent with a still constrained recovery, slowing jobs growth, and probably still that would point to inflation falling back to around the target of 2.5%.
Trump's tariffs are now on China, which has sort of sent the market into all sorts of paroxysms, and we don't know how that's going to end up going. Because JD Vance is saying, look, we still hold all the cards and we can still talk to China. We don't know what's going to happen there. And of course, you've got Trump's tariffs on pharmaceuticals, which could affect our pharmaceutical industry.
Yeah, but the tariff story has become uncertain again. It sort of waxes and wanes under Donald Trump. Obviously, we saw that huge spike in nervousness into April with Liberation Day. At one point there, the average tariff on the US was threatened to get above 30%. Then a couple of weeks later, he panics to some degree and announces a pause. Then there was a trade truce with China, and it all fell back down again to, I think, something around 15%, the average tariff going to the US. Then, of course, those deals have been announced recently, tariffs on pharmaceuticals and other products, and that sort of pushed the average back up to around 21% on our calculation. This is the average tariff going to the US. And on the weekend, of course, or Friday US time, Trump, in response to China putting more restrictions on exports of rare earths, Trump responded by threatening a 100% additional tariff on China from November 1 and various restrictions in terms of software exports to China. So that's led to uncertainty again. It saw the US share market fall quite sharply on Friday. It was down 2.7% or thereabouts. The S&P 500, a bit more for tech stocks, down 3.6%. And our market, as we're speaking, is currently down about 0.7% in response to that. So this is causing renewed volatility. I think our market is sort of thinking, well, we've seen all this before, it settles down. And of course, we've also seen more recent comments from Trump saying, oh, don't worry about China, almost saying that we'll work something out. And I think what you've seen from both China and Trump is a bit of negotiating, positioning, brinkmanship ahead of the still hoped-for meeting between President Xi later this month. And China's just playing the same game that the US does. And of course, that can be very unnerving for markets, but they're trying to position themselves with extra strength going into those meetings so they can take more off if they do have a deal. So I think ultimately we'll probably see a deal. There's a lot of pressure now on the US to cut a deal because we're that much closer to next year. Next year in the US is the midterm elections, various opinion polls show that one of the things that Americans hate is inflation, much like Australia, and they're not overly concerned about trade. Believe it or not, it's not high on their priority list. And Trump is getting poor approval ratings in terms of his handling of inflation and trade. So I think and reflecting that, he's recently talked about giving people the tariffs back, because most of the evidence suggests that Americans, either American companies or American consumers, are paying the tariffs. He's talking about giving those tariffs back to Americans. You'll say it'll be a gift from foreigners, but the reality is it's a gift from Americans back to Americans. And he's also taken pride at these latest polling numbers and trying to put pressure on states, including Texas, which has already moved to gerrymander the upcoming House of Representatives elections, congressional elections in the US for the midterms, to give Trump hopefully 5 extra seats. So that's leading to all sorts of pressure as well. But quite clearly, Trump is under some pressure here because he wants to retain Republican control of both houses of Congress in the midterms. If he embarks on another big tariff war at this point in time, then it will threaten that. So that's why I kind of think what we're seeing here is just positioning and bluster going into talks with China, and ultimately some sort of deal will be hatched. But time will tell. We don't really know for sure, and in the meantime, it's all added to a bit of uncertainty with markets, particularly at a time when the US government remains in a partial government shutdown.
Well, that's the other point, is with the shutdown, how's that affecting? I mean, Trump is saying it's all caused by the Democrats, but I find that hard to believe when he controls all three sections of the government, the executive, the House of Reps and the Senate.
Well, that's right, and most polls actually present seem to be blaming the Republicans and Trump for the shutdown. Democrats are playing a role, though, because there's the filibuster in the Senate, which means that some things, including this, funding the government, need 60 votes of the 100 to pass, and the Republicans have a majority, but it's only 3 or 4 senators, and one senator, I think, actually voted with the Democrats against the funding. So he does actually need some Democrat support to get a budget through, and therefore to reopen government. But in any case, the Americans, at present, polls seem to suggest they're blaming Trump and the Republicans more than the Democrats. And the Democrats are saying, well, okay, we'll give you your budget, but we want extra funding for health, because the One Big Beautiful Bill Act had a reduction in Medicare subsidies, which would mean that many Americans will see their health costs with health insurance go up come 1 January without those subsidies being continued. So that's where the Democrats are coming from, and they're probably thinking, well, things are going okay for us. We're not getting all the blame. It's going the other side. But we'll dig in. And in the meantime, Trump is saying, well, if you don't vote to reopen the government, we're going to start laying people off, which apparently they've started to do. Workers normally in a shutdown get furloughed. Those who aren't furloughed are told to stay at home, just don't get paid. So if you're an air traffic controller, you show up for work, you do your job, but you don't get paid, which is not a great inducement for confidence for Americans flying at present. But in any case, he's now actually starting to lay some federal workers off in areas that they don't regard as Republican priorities. And so that adds to the risks here, because if he's laying people off, then it could mean the shutdown could have more of an economic impact than would normally be the case. Because normally, what activity didn't happen is just made up for later when everyone gets their pay. That's at risk now, so therefore you could see more of an impact here. So this is all occurring. The tariff flare-up with China, the shutdowns, could all cause a bit more volatility in markets, and share markets have had a good run through the recent months, particularly in the US. August, September was strong again. That has left valuations a bit stretched and vulnerable to bad news, which is arguably maybe what the markets are starting to get a little bit nervous about, particularly with the tariff flare-up, but the shutdown operating in the background.
Well, with the shutdown, you've got missed paychecks and the drop-down in government services, and that will reverberate through the economy, surely.
It will reverberate through the economy, but there's been something like 20 partial shutdowns. So what happens in America when they actually have a shutdown? It's only non-essential workers or non-essential roles that are furloughed. So the Postal Service has its own funding. Many other US governments have their own funding, or US departments have their own funding. So they keep going. But areas like national parks, people staffing national parks, and monuments in the US, collection of government statistics, that's often regarded as non-essential, and therefore those activities cease. So currently speaking, there's about 2.3 million federal workers in the US. There's about 700,000 additional Postal Service workers. So in total, it's about 3 million workers. You've only actually affecting about 750,000 of those in total. And so the economic impact is negative, but it's not as great, because you're not actually shutting down the whole of the government, and total payrolls in the US, I forget it, something like 150 million or something. It's a massive amount of jobs over there. So it's a relatively small portion of the total workforce that's actually affected. But that said, if people start losing their jobs, or they're not given the back pay, that group of 750,000 workers, they're not given their back pay. A rough calculation is that's 0.02% of annualised GDP each week. So if you go on for 5 weeks, then you're knocking 0.1% off GDP directly. So you could have more of an impact. Historically, as I say, there's been 20 since 1976, 20 shutdowns. The average has been 8 days. This one's already gone beyond that. The longest was in 2018, 2019 under Donald Trump. Trump won 34 days. But when you look back on it, the economic impact on these shutdowns has been minor. But the risks are growing. This one could be have a bigger impact, because the government is starting to lay people off and threatening that they won't get their back pay.
So we'll watch that all of that with a great deal of interest.
We certainly will. It's an interesting time. I mean, Trump is, I would have thought maybe his strategy was, well, you do all the rough stuff this year, tariffs and so on, but as we came closer and closer into next year, the politics starts to impact again. And he won't be able to do as much if he doesn't get control of the Senate and the House again. It'll substantially restrict what he can do. And it's also possible if the Democrats get control of the Senate or the House, they can start inquiries into things. And that he probably doesn't want that to happen either. So it's becoming a more interesting time for Trump as we come into next year, given that the midterm elections are now just over a year away.
So we're watching that, and what happens with the RBA?
And the RBA, well, I think many Australians with a mortgage have been hoping that they're going to get more than just 3 rate cuts. If that's it, then it won't provide a huge boost to spending in the economy, and there's perhaps more risks that households may struggle with their mortgages. But I think so far the evidence suggests that they're not, but that's perhaps been helped by the strong jobs market. If you get the jobs market weakening and rates haven't come down as much, then you could end up with a somewhat slower recovery than many people have been hoping for. But hopefully, I think the RBA will still cut again, but there's just a bit more uncertainty around it at present, given those recent higher than expected inflation numbers.
Well, we'll watch it with a great deal of interest. Thank you very much, Shane.
Thanks, Leon. Take care.
So what's happening in the news? All right, let's dive into what's making headlines in politics, business and the economy. And trust me, there's plenty to unpack this week. We'll start in Washington DC, where there are an unexpected pairing. Prime Minister Anthony Albanese and President Donald Trump came together for what's being called a game-changing mineral deal. Yep, you've heard that right. Trump, sitting next to a beaming Albanese in the White House cabinet room, announced an $8.5 billion US-Australia investment push into critical minerals. That's about $13 billion in Aussie dollars. Under the deal, Australia and the US will pump US $1 billion, that's 1.54 billion Aussie dollars, each into Australian and US projects over the next 6 months, including US $200 million to a West Australian gallium plant owned by Alcoa, and US $100 million to the Gina Rinehart-backed Arafura Nolan's rare earths mine. The deal, which includes offering guaranteed price floors for new producers and blocking asset sales on security grounds, has potential to anger Beijing. China processes up to 90% of the world's rare earths and dominates the refining of lithium, graphite and gallium, giving it extraordinary pricing power across key inputs into everything from smartphones to fighter jets. Former head of the Australian-China Business Council, Warwick Smith, said Australia has now found itself dancing between two elephants. The signing of the US-Australia alliance on critical minerals comes just over a week before China's President Xi Jinping is due to meet Donald Trump on the sidelines of the APEC Leaders Summit in South Korea, which Albanese will also attend. The goal for this latest deal? Shack up China's dominance in the mineral space, the stuff that powers everything from your iPhone to electric vehicles and fighter jets. Trump, in classic Trump fashion, even cracked a line to reporters. In about a year from now, we'll have so much critical minerals and rare earths that you won't know what to do with them. They'll be worth about $2. Bold, vague, and a little bit Trumpy, as always. Now, the deal isn't just cash. There's a formal framework between the two countries, a kind of minerals pact, where both sides are pledging to support new producers by offering price guarantees, and they're even willing to block foreign buyers on national security grounds. Translation? Sorry, Beijing, you're not getting a piece of this. As part of the first wave of funding, the US and Australia will each invest $1 billion over the next 6 months. For Albanese, this meeting, the first formal one with Trump, was about more than minerals. He called it a new chapter in the relationship, saying the two countries are seizing the opportunity before us. Trump, for his part, didn't mention AUKUS much, but did say it was full steam ahead. So that's something. Meanwhile, back on home soil, there's corporate drama brewing at Santos. Sherry Dew, once seen as the heir apparent to CEO Kevin Gallagher, is out, and not in the usual off-to-pursue other interests kind of way. According to internal messages she sent to colleagues, Druce said she was dismissed just days after raising concerns about Gallagher's leadership style. Here's a timeline. She meets with Gallagher on October the 7th to say, look, I think I need to step down. Our leadership styles don't mesh. Gallagher, the head of HR, asks her to reconsider. She does, and sends a letter laying out what needs to change. 3 days later, silence. Then on October the 12th, Chairman of the Board, Keith Spence, calls her and says essentially, thanks but no thanks. Your services are no longer needed. And boom, that was it. This comes after a string of high-level exits from Santos, including their former COO and strategy head. So while Gallagher says he wants to stick around until 2027, the revolving door suggests that not everyone's on board with that plan. Let's talk Bapcor now. The Aussie car parts retailer that owns brands like Autobahn, Burson and Midas, they're in damage control mode after uncovering a $12 million mess in their trade division. We're talking accounting errors, operational screw-up, and 2 execs who've been shown the door. Their half-year profit outlook slashed by 32%. Investors were expecting up to $80 million. Now the forecast is as low as $3 million. Yikes. CEO Angus Mackay, who's brought in after a failed takeover attempt by Bain Capital, told investors, we weren't expecting this. A modest issue turned into a major one. That's not exactly confidence-inspiring. Bapcor's share price plummeted 17% on the news and now sits at $2.60, less than half what Bain was offering back in 2024. So if you're a shareholder, that one stings. All right, and just when you thought corporate strategy couldn't get more creative or controversial, let's talk about Healthscope. Now, Healthscope is Australia's second largest private hospital network, but right now it's also in receivership, drowning under reported $1.6 billion in debt. Despite that, its 37 hospitals are still running, while administrators scramble to find a buyer for part or all of the business. But here's where it gets wild. HealthScope is trying to become a charity. Yep. A private for-profit healthcare giant is now moving to rebrand itself as a not-for-profit. The goal to access tax benefits and stay afloat. And if that wasn't eyebrow-raising enough, they're also asking 15,000 eligible staff to help out by tapping into a tax break, then handing up to 90% of that benefit back to the company. Let's break that down. There's this long-standing tax perk available to workers in not-for-profit hospitals. It lets them salary package up to $11,660 a year, reducing their taxable income. Normally, it's a recruitment and retention tool. Staff keep that tax break as a little boost in their pay. But under HealthScope's proposal, workers will be given the company nearly all of that benefit to help pay down its debt. Health Services Union leader Kate Marshall didn't hold back. She called it literally taking money out of workers' pockets to pay their billions of dollars worth of debt. And honestly, it's hard to argue with that framing. Here's how the numbers stack out. If 70% of staff take the deal, HealthScope keeps 90% of the benefit. If 90% of staff jump in, the company's cut drops to 60%. Either way, taxpayers could be out tens of millions of dollars, while workers would only see a fraction of what's meant to be theirs. CEO Tino Laspina, though, is selling it as a lifeline. In an email to staff, he called it an exciting development, saying that the move to charity status, now approved by the regulator, gives them huge confidence to continue as a for-purpose organisation. There's even a new name floating around, Purpose Co. So the rebrand is on. The charity conversion is real, and the salary packaging plan? Highly controversial. Whether this strategy actually works or just burns goodwill with the staff and the public is going to be one to watch. But one thing is clear. This one is one of the most unorthodox plays we've seen from a major private company in crisis. Zooming out a bit now, the big picture isn't looking too rosy for construction, healthcare or mid-tier retail either. Insolvency experts are warning the company collapses are likely to remain at record highs into the next financial year. According to restructuring firm Alvarez and Marshall, it's mainly the smaller businesses still feeling the pinch, and it's sectors like construction and private healthcare that are wearing it hardest. Here's what partner Jason Tracy had to say. We're seeing the unwinding of what you might call the COVID hangover. In other words, businesses that got a temporary lifeline during the pandemic are now running out of road. In construction, it's those brutal fixed-price contracts doing the damage, where the builder carries all the risk and none of the reward when costs blow out. Healthcare, same story. Private hospitals are battling rising costs, tight margins and outdated funding models. And in retail, the mid-market is being squeezed. You're either at the luxury end or the bargain basement, or you're in trouble. To top it all off, the tax office is stepping up debt collection. Businesses that skipped super or GST payments are now on notice. According to the ATO, there's around $50 billion in unpaid tax floating around, and they want it back. You know what's also interesting? Australia's biggest law firm, Minter Ellison, and some major players like Grant Thornton are flipping the traditional corporate hierarchy on its head, all thanks to AI. But it's not the senior execs leading the charge. It's Gen Z. Yep, the youngest people in the room are becoming the internal AI consultants. New research from Microsoft is showing that these early in-career professionals aren't just using AI, they're shaping how their entire organisations use it. They're the ones bringing in new tools, tweaking workflows, sharing contacts, and honestly, completely reshaping how their teams operate. Sarah Carney, the CTO of Microsoft Australia and New Zealand, put it pretty bluntly. She said, this isn't a technological change, it's a cultural change. And this shift is huge. For firms like Minter Ellison, it's not just about efficiency, it's about unlocking innovation from the bottom up. These younger employers are being asked for their opinions, and not just politely heard. Those ideas are actually being implemented, and the numbers back it up. Microsoft's report, cleverly titled Control Plus Career, How Gen Z are Redefining Success at Work with AI, found that 70% of Gen Z workers have introduced a new AI tool, shortcut or prompt trick to their team, and their colleagues actually ran with it. Even more impressive, about 6 in 10 have taken it a step further, building or customising their own AI agents or automating workflows to streamline stuff they used to do manually. That's what Microsoft is calling the rise of the agent boss era, and it's giving those employees a seat at the table earlier than ever. Take Jeff Potter, for example. He's a Gen Z consultant at Minter Ellison and part of the AI advisory team. For him, AI has been a career accelerator. He's no longer stuck doing admin. He's in strategy meetings with partners and directors, building AI and even designing training courses for clients. He recently built a short AI training program grouping common questions into modules, pairing them step-by-step prompts. That kind of initiative isn't just noticed, it's valued. And such as law firms see this shift. Over at Grant Thornton, Nicole Brady, who heads up their private tax and advisory team, said she's genuinely excited by what she's seeing from new grads. She made a great point. With up to four generations working side by side now, staying curious and open to learning, especially about AI, is more crucial than ever. And that brings something that really stuck with Sarah Carney's observation. If I was a manager, weekly show and tell things I'd be implemented. So you can hear voices from across the organisation. How simple is that? Just carving out a space for people, especially younger team members, to share what they're doing with AI. That's how innovation spreads. That's how companies move beyond AI paralysis. The pilot program, endless testing, and start actually using this stuff. Because at the end of the day, AI transformation isn't just about having the best tech. It's about having a culture where people feel empowered to experiment, share, and build each other's ideas. And right now, Gen Z, they're leading that charge. And just when you thought politics couldn't get any weirder, the Nationals set to walk away from their commitment to zero emissions in what some are calling the last Jeff Barnaby Joyce from jumping to one nation. Yes, that's real. Joyce says he won't be part of any party room that backs net zero. And Insider says he's talking to Paul Hanson about running for the Senate under One Nation banner, possibly be replacing it down the line. Pauline, by the way, is loving this. She's publicly invited Joyce and even a few other coalition MPs, like Jacinta Price and Matt Canavan, to join her. One Nation support is now sitting at 14%, more than double what it was the last election. It's being driven by disaffected voters, mostly old and regional, who feel alienated by the parties on issues climate and immigration. So what happens next? Well, the coalition is reviewing its climate policy, but the Nationals are tracking their own review and are widely expected to ditch zero together before Christmas. That's sure to stir up serious tension in the coalition camp. And that's a wrap for this week. From billion-dollar deals to boardroom blow-ups and political plot twists. It's been a wild ride. And we're only in October. If you like today's breakdown, make sure to follow and share the podcast with someone who needs a catch up on what's really going on in Australia and beyond. And next week I'll be talking to Dino Bevarakis, who was managing director for Avaya. We'll discuss the future of vibrant work, how organisations stay compliant, and how we can support employee well-being in the workplace. And I'll be talking to Dita Pickering about the uptick in Australia's unemployment. For the most exclusive access to learning economists from around the world, subscribe to Talks from my website, Gettler.com, or whatever your favourite podcast platform is. If you like Talks, please leave us a review with Apple Podcast. Thank you in advance. In the meantime, you can find me on Facebook, Twitter, or X now known, Instagram, and YouTube. If you want to contact me, email me at leon@leongettler.com. I answer all emails. Also, in my spare time, I have a copywriting business. If anyone needs blogs, articles, email me. Looking forward to the next episode of Talking Business next week.